Okay, I'd like to take this opportunity to welcome everybody to today's event sneak preview model ETF portfolio. Yeah, John Hopkins here. Tom Bowley going to be joining us in just a minute. I actually want to be really brief so we can get right to the meat of tonight. The session, like all of our webinars, will be recorded. So in the event you're unable to stick around, don't worry about it. We'll make sure you get a copy. Tonight's focus, Tom will be talking about the new service that we're looking at, the ETF service. So this is not an individual stock question night, or if you have any general questions about the service, you can just go to our website to the contact us and send us a question, we'll get to it. We really want to focus on the ETF portfolio. If there's time for questions at the end, we'll take a few. Otherwise, again, you can just write to us and we'll get back to you promptly. Okay, I really want to step aside so Tom can jump into this. I know there's a lot to cover. How's it going, my friend?
It is going well, John. How are you doing?
I'm doing good. It's, you know, what can I say? You wake up and, you know, the market, NASDAQ almost touches its all-time high and everything else is on fire. So, hey, if you're a bull, you got to like what's happening right now.
Yeah, and that was really the topic and what I wrote about in Chart Watchers over the weekend. I mean, I honestly feel it's checkmate for the Bears. You know, when I've talked about these outlooks, these market outlooks in the past, whether it was back in July for the second half of the year, when I did the quarterly, you know, one of the things I was looking for to help confirm the uptrend and the continuing bull market was I really wanted to see, well, two things really. One, I wanted to see the transports break out. Not that I'm, you know, rushing into transports. It's just that it gives further confirmation to the market moving higher. Many of you probably are familiar with the Dow theory, saying that when the Dow Jones breaks out and then you get the transports or vice versa, that is the confirmation that the market is in bull mode status. I think it's just a matter of time before we get the Dow breaking out. I think there's some obvious reasons from the pandemic why the Dow hasn't broken out. Many of the components have broken out long ago. They broke out, but we do still have some areas of the market that are struggling with the pandemic. So I think it's just a matter of time before we get that breakout. But I really like the transports breaking out. That was number one. And then number two was seeing the 10-year treasury yield starting to move, because as that moves up, that's rotation. And if you study the history of the stock market, the S&P 500, you'll know that when the 10-year treasury yield rises, and it doesn't have to go to 5%. I mean, anytime it's moving up, money is rotating. It's moving out of treasuries. That's what sends the yield higher. So it could literally just be a move to, you know, 0.85% or maybe 1% or 1.25%, whatever. Any kind of move like that, in my opinion, is going to lead to massive buying in the S&P 500. So we've got both of those things happening now, in addition to being in a ridiculously low interest rate environment with many companies, not all companies, but many companies showing tremendous growth. And having practiced in public accounting for many years, this is all, you know, this is nirvana in terms of valuations. You know, growth picking up and then discounting that growth back using historically low interest rates. I really struggle to find the bearish argument in all of this from any rational discussion points. But anyhow, that's kind of where, you know, I tend to agree with you. I think we've got a lot of positivity going in. So, but it is great. We have a tremendous crowd here today, and they're still pouring in. I want to thank everybody for coming in. This is a big day for EarningsBeats. This is a brand new service that we're talking about tonight. Obviously, it's a sneak preview of our model ETF portfolio. Those of you who have been members of EarningsBeats knows you all know what our portfolios have done. If you're not aware of what our portfolios have done, all you have to do is go to our homepage, and you will see, because we update them every day. And we compare them not just for since inception, but also the current quarter. We compare versus the S&P 500. That's the benchmark we try to outperform. And as we unfold and unveil this new service, that goal is not changing. You know, as far as the ETF service, we want to outperform the S&P 500. It's going to be more of a challenge, I can tell you that, and I'll explain why as we go through the webinar. But why don't we go ahead and bring up that agenda and the things that we want to talk about for this event. So you've got obviously the introduction. That's what this is. Again, want to welcome everybody. Really appreciate you taking time out of your day to be here with us. I think you're going to find some interesting information. For those of you who are new, and even those of you who have been with us for a long time, I think it's really important that you understand the key EarningsBeats strategies. Even, you know, I'm not talking about ETFs. I'm talking about our strategies in trying to outperform the S&P 500, all of the research that we do and so forth. It's really important to understand, because when we evaluate these ETFs, they're filled with, you know, a basket of stocks. So you can't just look at the ETF and say, well, hey, that's a cool name, I'm going to jump into that. It's not the name that drives the price of the ETF. It's going to be the stocks that are included, the basket of stocks. And so evaluating that basket of stocks is going to be really important for us in terms of which ETFs we like. There might be an ETF that's going, you know, crazy, but you might pull up the top 10 holdings and find that 5 of them are over-the-counter securities. You know, companies that don't trade much, not subject to the same, you know, rules and regulations. And those are companies and stocks and ETFs that I'm not going to be interested in personally. You know, and then I think also you take a look at some of the sector weighting and so forth. There's a lot of things that we need to talk about. And so my whole point is there's going to be a brief period, maybe 10, 15 minutes, where I'm going to need to go through these strategies for those folks who are here that are not aware of what we do at EarningsBeats. I think it's really important that everybody have at least a general grasp. So we're going to go through that. I'm going to talk a little bit about our strong ETF chart list, because this is going to be kind of like our strong earnings chart list. That's kind of the, you know, that's the real engine of our service. And as we move into ETFs, I think the strong ETF chart list is going to be very similar in that our model ETF portfolio is going to come from that strong ETF chart list. So I want to talk about what it represents, how we're going to select those, and so forth. I want to talk a little bit about limitations of ETF investing. There's plenty of those. I'll be honest, I'm not an ETF fan, and I'll go into why in just a little bit. But having said that, I know that many of you are interested in ETFs. It's simple. You can buy an ETF just like, you know, you buy stocks. An ETF, if it holds, you know, the SPDR, for instance, holds 500 stocks. Well, to go out and buy those 500 stocks would be a little bit of a chore, but it's push one button to buy the SPDR, and all of a sudden you've got this well-diversified, well, maybe not well-diversified depending on all the market cap weightings and so forth, but you know what I mean. We got a lot of stocks, and they'll all help to influence the direction of that particular ETF. So anyway, there are a lot of limitations. We're going to go through those. Evaluating the ETFs. So exactly what are we doing to evaluate? Okay, so they're on our strong ETF chart list. How do we decide which ones are eventually going to be picked for our model ETF portfolio? I'm going to talk a little bit about that. I'm going to give you some examples of how I'm going to be evaluating these ETFs. And then we'll talk just briefly about the draft, which is next Monday, October 19th. That is for members only. This is free. It's open to the public. We've been encouraging everyone to come in. I think we're going to give you a lot of really good information if you're new to EarningsBeats. But if you want to be part of our draft and our long-term evaluation of these portfolios, both our stock portfolios and this new model ETF portfolio, you will need to be a member. And you can be a member at any level. It can be a trial member. So we have a $7 30-day trial. So you certainly can do that. Or you can be a monthly member or sign up for our annual membership. So the first thing I want to do as we get started, and we always do this, our members know, is we want to just bring up the webinar special. We always have a webinar special, and I'll tell you what, this one is going to be a really, really good one. And so I want to share that with everybody before we get started. All right, first up. So if you go into EarningsBeats and you look toward the top, you're going to see this webinar special link. If you click on that, it brings up the webinar special. So you can always go back and take a look at this. It is in effect through Friday, October 16th. So the rest of this week, all the way through Friday. The big change here is right now, our ETF service for all of our members is going to be free through December 31st. If you're a member of EarningsBeats, you're going to get the ETF service. It's going to continue to evolve. We're going to want your feedback, what you like, what you don't like, what you might want to see added, that sort of thing. And so there's going to be no charge for anyone who's just a member, whether you're trial member, monthly member, or annual member. Through December 31st, there's going to be no charge for the ETF service. So as we evolve and change things and ask for your feedback and so forth, we don't want to charge you for it. We want you to see what you think of the service. But what we will say is this: for anybody who signs up to our regular service and signs up for the annual service, which we always charge $697, and you'll see that down here at the bottom, $697. Anybody who signs up for that will also receive our ETF service until you have to renew. This is a 13-month commitment for $697. Normally, we include our regular service at $97 a month times 12 months, and then you have a bonus month of $97. That's that 13th month. And then we come up with a total, which I don't know, is like $1,200 and some bucks. And then we tell you, well, you can always get the annual for $697, at least while we have this special running. So you save about 44%. Well, our ETF monthly service right now, we're considering $77 a month. And if you consider having to pay for both of these services, and we'll have bundled packages that'll be less than this, but just, bear with me here. The 97, the 77, add them together, 12 months, plus a bonus month of the two, another $174 to purchase these two services individually for the next 13 months would cost $2,262. If you sign up for our annual service, $697, you will not have to pay anything additional for our ETF service until the end of this 13-month period. Now, if you're already a member and you've got some time left on, you decide to extend to go out 13 months, it's going to continue. It'll just add on the 13 months, and you won't have to worry about an ETF charge until the end of that period. So if you had another 6 months left, you tack on 13 months, now you got 19 months. You won't pay anything for the ETF service for 19 months. We think it's a great way. If you think from what you hear tonight that you really like this service and you like the idea, and you think that maybe, hey, if I can get an ETF service that outperforms the S&P 500, it's just giving you essentially an extended period of time to evaluate this at no cost. So I think it's a great deal. It is by far the best deal we've ever offered because it is including this new service. So think about taking us up. You've got until Friday to make that decision. So you can check out tonight. You can, if you're new to EarningsBeats, check out our entire service. You will get the rest of your trial as well. I always like to point that out. So if you just started your trial today, or if you want to start one tomorrow, and by the end of the week, you really like the service, you want to take us up on this annual deal, you'll get the rest of your trial, and then we'll tack on the 13 months for the for the $697, and you won't have to worry about renewing again for what would essentially be 14 months because you'll get that extra 30 days. Anyway, I wanted to make sure everybody's aware of that. I think this is a great deal. Check that out. And if it's something that you think would be appealing to you, take us up on the offer before Friday. All right, I want to get into recap of our current strategy. So it's really important that you understand a few things about what we do at EarningsBeats. Number one, I cannot stress this enough. We provide what I like to call research platform for our members. We educate. I love to educate. I've learned a lot about the market over the years, and I owe a lot of folks out there kudos for the things I've learned and that they've passed on to me, especially John Murphy with a lot of his intermarket work. And I think through a lot of the things we do here at EarningsBeats, I'm literally just passing the baton. on to hopefully save a lot of you a lot of money that I lost in tuition over the years learning about the market. So that's the whole idea. We are not registered investment advisors. I cannot stress that enough. We are not registered investment advisors. I'm not a registered investment advisor. Neither is John. Neither is anyone that works at EarningsBeats, and neither are we as a company. None of us are registered investment advisors. We are educators, and we provide, like I said, a research platform. So anyone who writes in and says, what do you advise me to do? I'm going to write back number one and say, we don't advise. We are not registered investment advisors. We're not licensed to advise. What we do is we provide a platform, we educate, and then it's up to each individual to do whatever you feel comfortable. If you don't feel comfortable, don't do it, or check with your own financial advisor. Once again, I can't stress that enough. I want to make sure everyone is completely aware of that. We try to be very transparent in that regard. All right, so let's move on. I want to show you, first of all, some of the things we do. If you're new to EarningsBeats, I'm going to try to go through this fairly quickly. We do portfolios. So this Model ETF portfolio that we're talking about announcing next Monday, this is just an extension of other portfolios that we already have. If you go to EarningsBeats and just go to, let's just go to the home page. No, I think I have to log out. Then go to the home page. You will see this is what I was talking about in terms of our performance right here. These are our portfolios. These are portfolios of stocks where we hand select the stocks. Every quarter, 10 equal weighted stocks go into each portfolio. You can check out our performance. It's been updated through today's close. I mean, we try to keep things updated literally right after the close. Abby will go in and update this for us and for all of our members or for anybody that's viewing our page. So there's nothing, that we're hiding. We give you our since inception returns and provide those dates. And we also talk about the current quarter, which started for us back on August 19th. That was when we announced our latest portfolio stocks. That's when we had our stock market draft for our portfolios. Next Monday will be our ETF draft. Anyway, so there's a lot of great information there. If you're new to EarningsBeats, check it out. So when you look at our performance, I mean, I'll just show you one of our portfolios because I don't want to spend a lot of time here. But here you can see the model portfolio. We track it. We use at Stock Charts their user-defined index right here to provide all that information. So I can go in here, I can pull up our top 10 picks, which is basically our model portfolio. And you will see, now I have only updated this through Friday. I have not updated through Monday. So it doesn't exactly agree to what we have on the website because I do this independent of Abby, just to make sure we have two independent calculations. And I want to make sure that they are correct. So it's just a little double check on our end. But I've updated, I do a weekly portfolio report for all of our members over the weekend. So I always update it through Friday. So that's why it's a little bit different. But 264 is where we currently stand. 264.49 is where we stood as of Friday's close. Now, when I go back and show you the chart, you can see there's the 264.49. That's as of October 9th. Now, if I went in and updated the user-defined index for what Abby had posted on our website, it would now be showing 267.74. And actually, I think we have like a 3/100ths of a difference or something. I've noticed it's probably something to do with rounding. But here, this would now show 167 if I were to update it through today's close. Over the same period, the S&P 500 is up about 31%. It was 29.2 as of Friday's close. So 167% versus 31, I think we're doing something right. And this is our 8th quarter on the model portfolio. We have already outperformed the S&P 500 in 6 of the last 7. And if you take a look at the current quarter, you'll see right now we have a pretty sizable lead over the S&P 500 once again. So unless some things really change between now and November 19th, we are set to outperform the S&P 500 in our model portfolio for the 7th time in 8 quarters. So that's a pretty big part of our service. Now, when we look at these portfolios, it really comes down to a lot of the research that we do. We don't just show up one day and just say, here, these are the 10 stocks we like. It's already done and provided to our members through our chart lists. We use that feature at Stock Charts. We have chart lists. And so, for instance, we have a strong earnings chart list. And we have various chart lists. We have a strong earnings, strong AD, weak AD, strong future earnings, raised guidance, and short squeeze. Those are our 6 primary chart lists, along with chart lists for each of our 4 portfolios. So I would say that those are the 10 primary stock chart lists that we have. We also have an industry group relative strength chart list that we send out to all of our annual members. So again, if you take us up on that annual offer that I mentioned a little bit ago, you will also get that. That's 11 different chart lists where we've done research, put all the work together, and literally you go to our website, and I'm going to show you how this works very quickly. I'm not going to download, but I'll just show you where you go and how you do this. Let me see if I can get back in here. So if you go to chart list, once you're in as a member, you can go right down here, strong earnings chart list. This password's really important, especially the first time you download. You need this password, so you copy that, and then you click on the strong earnings chart list. The password comes in, you paste it, and you can download this right into your Stock Charts account, as long as you're an extra member or pro member. If you're a basic member, you can't download other chart lists because you're only allowed to have one, which is the default that you get set up with when you start with Stock Charts. So if you're extra member or a pro member above, you can just drop all the stuff right into your account. Very, very cool. But strong earnings chart list, this is a chart list that includes companies that have reported strong quarterly results, are liquid, have strong technical outlooks. Really, it's just the marriage of strong fundamentals with strong technicals. I like to look at our portfolios as, for the most part, the best of the best. I go through our strong earnings chart list and I look for companies that meet our criteria in each of our portfolios. The only exception is our strong AD portfolio, which is our strong accumulation distribution portfolio, which is our best performing group, by the way, this quarter. And that one is based off of the AD line. That's a technical indicator that we really started using this year because of the pandemic. I think it's been the best indicator. We do a strong future earnings chart list, and I can tell you I need to update that right now. And by the way, this strong earnings chart list, I forgot to mention it in today's daily market report, but we did just update this today. So anybody who hasn't come in here and updated recently, come in, make sure you copy this password, click on it, you can update your strong earnings chart list. Essentially, there were only about 15 companies that were added, but a lot were removed because they're coming up on with earnings. As earnings season gets ready to kick in, we removed a bunch of earnings reports. Most of those that we'll be reporting over the next 2 to 3 weeks have been removed. When I update the strong future earnings chart list, that will then include a lot of the ones I just removed, because our strong future earnings chart list contains companies showing strong technicals that are not already on our strong earnings chart list. So a lot of really healthy companies technically that are removed from the strong earnings chart list as we approach earnings are then added to the strong future earnings chart list. So when you run scans, and we have, I'm not going to get into scanning strategies, but when you run some of our scans, you can run them against multiple chart lists. So one thing that I do a lot of times is I'll run a scan against both the strong earnings and the strong future earnings chart list, because in theory, if they're updated on the same day, which they have not been right now, that's one thing I need to do. Probably will try to get that out by tomorrow. But in theory, neither of these two chart lists should have any common stocks. There's no common denominators in terms of the stocks, because anything that I'm going to put on the strong future earnings chart list, I make sure it's not already on strong earnings chart list. Anyway, those are two of the list. Strong AD chart list and weak AD chart list. These were developed back in March when we had all of the coronavirus issues. A lot of stocks were accumulated back then. A lot were distributed. We use these two chart lists to identify companies that appear to be accumulated. And then the weak AD list is, and you can see those down here, by the way. There's the weak AD list. Here's the strong AD list. They can be downloaded into your account. But the weak AD list is the chart list designed to capture stocks that have been really weak in terms of not just relative strength, but also in terms of their AD lines. Short squeeze chart list. This one has gained so much in popularity with our membership. We track the most heavily shorted stocks, and when they break out, it can be sizzling hot to the upside. Maybe to just give you an idea, you could go in and take a look at a stock like Jinko Solar. Mentioned this one back. Well, I mentioned it multiple times, but I know when I was doing my show and it was broke out above 29 with its earnings report, the stock had a pretty high level of short interest in terms of its short percentage of float. And this chart list, our short squeeze chart list, is literally a listing of all of the highest or most heavily shorted stocks. Look at what Jinko did when it broke out. Think about all the folks that are on the short side that have nowhere to go. And it becomes very emotional when you are losing money to the tune of this. You have unlimited losses when you're shorting. You know, you go long, you put 10,000 into a stock, you can't lose more than 10,000. If you short this stock when it's 1250, say you short 1,000 shares, right now you owe 59,000. You've lost 47,000 if you happen to just have poor timing. Well, if you haven't covered, you're probably getting margin calls and everything else. And it gets very emotional. You just don't want to be on the wrong side of a short squeeze. You do want to be on the right side though. So we have a short squeeze chart list and then a raised guidance chart list, which just contains companies that have raised guidance in the past few months. All right, so that's kind of the background of the research work that we do in putting together these chart lists. And the reason I bring this up, and this is important, when I go to evaluate the ETFs later, I'm going to show you when you put in a stock into stock charts, how you can find out whether that stock, or you can find out what chart lists in your account that stock is in. So I can quickly find out if stocks in an ETF have raised guidance, or if they've produced strong earnings, if we think that they're really strong companies and we included them in our strong earnings chart list, we can see if they're on the short squeeze chart list. The more of our chart lists that these companies in the ETF are on, the better I'm going to feel about owning that stock within that ETF. And if that stock happens to be one of the largest holdings in the ETF, it's going to make me feel even better. So that's why I wanted to bring this all up. I want you to just be aware of the research platform that we have, because I think this is going to come into play in a major way when you're looking at ETFs. Okay, so that's essentially the recap of the key strategies. Our philosophy, I've said it over and over again, you really don't have to be an EarningsBeats member to know that our philosophy is leading stocks and leading industry groups. We are momentum traders. There's a reason why Wall Street is pouring into these companies, and we want to own them. You know, everyone's been saying for months now, Tesla's overbought, Tesla's overbought. Can't possibly get in, it's stretched. Well, it's been stretched since it was about 400, and now it's 450 after a 5-for-1 stock split, which means it's 2,200 and change from 400. Folks were, they didn't believe in it when it was at 400, 500, 600, 800. We put it into one of our portfolios when it was 800, and I said within 3 months I wouldn't be surprised if the stock was 1,500. I was wrong. It was 1,800. I mean, these companies, when they get on these analyst lists and Wall Street's going back, their analysts are going back to their firm saying, buy Tesla. And then you've got technical traders piling on, and then you've got short sellers piling on. These stocks can, have a mind of their own. And as long as they're going up rapidly, they carry your portfolio. And so the idea is to be involved with leading stocks and leading industry groups. But this Jinko Solar chart is pretty amazing. All right, so next I want to move on to our strong ETF chart list strategies. So this is what we're going to be doing initially. And some of these, strategies may change over time. It is likely that, and I'll just bring up one of these chart lists. I'm going to go through this particular ETF a little bit later in this webinar. But just to give you an idea, here's the First Trust Dow Jones Internet Index Fund. I love internet stocks right now. You got technology. You can see the sector weighting. This is kind of some of the information that we want to share. So once we put together a chart list, every ETF that you pull up that's in our strong ETF chart list will provide this information for you. Top 10 holdings, sector weighting. I will likely go in here and be adding some support areas and resistance levels and so forth. But, you got to keep in mind, and this kind of gets back to limitations on ETFs, but an ETF doesn't trade like a stock. An ETF trades based on the basket of stocks it owns. So a support level, if FDN is breaking down below a prior low, it means maybe some of these individual stocks have broken down below some lows, but it's not a reason that I would sell the ETF. It's kind of hard to explain, but it's like a price support of price support, price support of all of these companies' price supports. This is just the total performance, if you will, of all of the individual components. So the ETF is just going to go wherever its components go. It's not, don't think of it as trading like a stock, even though technically that's what it does when you buy it in your account. It's just some of the short-term inefficiencies are not quite the same as they are with the individual stocks. So I just want to kind of point that out. But this is what we're thinking about doing on our chart list strategies. Number one, we're thinking about updating the chart list monthly. We go through a lot of earnings reports. So the strong earnings chart list gets, updated more often when we're going through earnings season and less often outside of earnings season because there's just not that many things that are taking place when earnings aren't coming out. Well, with ETF, it doesn't really matter. I mean, as earnings come and go, the top holdings really don't change. Most of these ETFs are not going to be designed to get rid of stocks right before earnings and then add new ones, after earnings, kind of a thing. So there's no need really. I think monthly is going to be often enough to give us a really good idea of what the strongest ETFs are out there. So that's point number one. Point number two, I think in terms of relative strength, two things are going to be really important. Number one, down below, we're going to show on the charts in this case, FDN, the ETF, relative to the S&P 500. If an ETF has been going up only for the last 3 months, and if you go back over the last 3 years, and it's been going down mostly for 3 years, and it's just getting a little bit of a dead cat bounce, that is not going to be nearly as impressive for me as, an ETF like this one. When I look at this one, I look and see sector weighting, technology, communication services, consumer discretionary. That's kind of important to me because it's telling me areas that it's investing based on sectors. And in our industry group relative strength chart list, of course, we follow all of the industry groups within each of these sectors. So I can tell you that these are my three favorite sectors. And so when I look at this, I'm going to be pretty happy with an ETF like this because it is favoring the groups that I'm very bullish on. So anyway, FDN relative to the S&P 500 is important. The other relative strength criteria that I think is going to be important, and what I am probably going to be doing, I'm going to change the chart because I can tell you right now, rather than the RSI, I want to have the scooter on the chart. So I am going to move this. I'm going to make it above. And I think it's going to be pretty important. So what I am going to do is move I want the scooter line to be above the PPO, so I'm going to update this. And so now you can see where the scooter score is. For those who are not familiar with the scooter score, this is simply an acronym, Stock Charts Technical Rank, SCTR, Stock Charts Technical Rank. This was developed by John Murphy, and it simply just pits this ETF versus other ETFs based on the criteria that John used in coming up with this formula. I can tell you when we get into the limitations, there are limitations with the scooter, and I'll get into that in just a minute. But I do think it's important to know how this fund, this ETF, stacks up versus other ETFs. And the scooter is one way to evaluate that. So once this ETF moved into the 70 and above category, you can see it stayed there. And while it's been there, look at what the group's been doing, and look what it's been doing relative to the S&P 500. So if you get one of the top performing ETFs, you got a much better chance to outperform the S&P 500. And this doesn't mean that the ETF goes up every day relative to the S&P 500. I'm assuming many of you that would be interested in trading ETFs are people who are probably going to watch the market every single day. You're not going to panic, based on, intraday or even intra-week or intra-month movements. You're going to stick with the ETFs over time and then, evaluate performance. And so I think that using the scooter in this fashion, I think is pretty important. So you could see, based on the selection process, if I say I only want ETFs with scooter above 70, you can see that criteria would be met by this ETF and would have been met ever since back in April. So this would have started coming up on our list back then. We are going to avoid leveraged ETFs and inverse ETFs. I'm very bullish. If you don't know me by now and my position on the market, I think we're in a secular bull market that isn't just a bull market for the next couple months. I believe we're going to be in one for the next decade or more. Could we have cyclical bear markets along the way? Absolutely. We saw one in fourth quarter of 2018 with the trade war. We saw one earlier this year, one of the worst cyclical bear markets in history, similar to the 1987 crash, but it's within a secular bull market. So you tend to reverse very quickly. It's not drawn out over 2 or 3 years like 2007 to 2009. That is a secular bear market. Hopefully you understand the difference. That bear market, that financial crisis, that was the end. That was after we had already gone down so much. We took another major hit on top of it. And I always say, I'm so thankful, and I think we all should be blessed, to feel blessed, that this pandemic did not occur back in 2008 when we had a financial crisis. If the pandemic had occurred in the midst of all that, we probably would have had the Great Depression 2.0. But while everybody was screaming back in March about the Great Depression, I actually wrote that we were in a secular bull market. People thought I was nuts. But it's that big picture that I think you've got to be aware of. And we came roaring right back out of that and finding strength a lot of times dependent on following that strong AD, the accumulation distribution line. But anyway, we are not going to get into leveraged ETFs or inverse ETFs. Inverse ETFs, again, because I think we're in a bull market. I'm not interested in an inverse ETF. And to be honest, inverse ETFs are not going to be posting scooter scores above 70. They're going to probably be looking at scooter scores down around 0 because they're getting trounced as the market goes higher. The other thing I'm not interested in is leveraged ETFs. It's kind of like our regular service. We don't do options. And I'll get questions from members and say, do you have an option service? And my answer is no, but you can use our service to come up with great stocks for trading options. We're a momentum-based service. I think many of our portfolio stocks, my goodness, if you were in options on some of these that have taken off, I can only imagine the returns. But that's for those of you who want to take on that additional risk. And that's fine. Again, that's a choice that individual members are making. As far as our leveraged ETFs, I look at it very similar to options. If you want to leverage some of these ETFs, if we talk about, hey, I really like technology, or I really like small caps or whatever, and you want to take that information and leverage it, that's your decision. That's your call. We are not going to provide a leveraged ETF in our strong ETF chart list, and we're certainly not going to have them in our model portfolio. Keep in mind, we've got a lot of members with varied risk tolerance levels. So it is not a one size fits all for all of our members. And we really try as best we can to communicate. If I talk about something that, a stock that's really high risk, I try to think about it and to let our members know. Because if you're someone who can't sleep overnight, if you think your stock might lose 15 or 20% in a day or 2 days or a week, well, maybe the short squeeze chart list isn't one for you, because those stocks are all over the place. But maybe the strong earnings chart list, going in and finding some of the more defensive stocks in that list, that might be, right up your alley. And then we have other members who are just like, give me the risk. Either I'm young and I don't care. I just want to try to make a lot more money. There might be some of you out there that are, your upcoming bills throughout retirement are not a concern. You've built a lot of wealth over the years, and you've got money, and you like to take on a little bit more risk when you invest. But again, we have members that are all over the place. So us making that risk decision for our members, I don't think is the appropriate approach. So we are not going to have leveraged or inverse ETFs. We are also not going to have foreign ETFs. I'm just not comfortable. I feel like my expertise is evaluating U.S. stocks, and getting into portfolios or into ETFs that are concentrated in other countries. I don't think that's where my expertise is really going to come in. And I think we've got plenty on our plate with U.S. stocks. I just don't think that's something that I'm interested in. So if foreign investment is part of your overall big picture plan, you can simply add it to some of the things that we do here at EarningsBeats. We are also avoiding bond ETFs. I want to outperform the S&P 500. I can't do it with a balanced portfolio in a secular bull market. When I think stocks are going higher, I want to be in aggressive areas of the market. That's where your outperformance is going to come. It's not going to come from bond portfolios. Bonds are going to underperform by a wide margin in a secular bull market. So I have no interest in bond, and that's why I don't want to be in bond ETFs. Again, if you want to balance out your portfolio, by all means do it, but you'll need to go, check out these various bond portfolios and find one that's appropriate for you. This one is a little bit subject at this point to maybe some thought. And that is, I was thinking we'd have a limit on, we want to make sure that our ETFs are liquid. And so I was thinking, 100,000 shares a day on the ETF. That would be an average that we'd be looking at. Maybe we go down to 50,000. I don't know. It's just something. We're going to have a limitation. I just don't know what that limitation is right now. I think to start out, we'll probably be looking at 100,000, maybe 200,000 in running the sample. And the other thing is, as we put together our strong ETF chart list, we want to kind of keep that to we don't want 400 ETFs in there. I'm thinking we want to keep it maybe between about 25 and 50. So filtering and what filters we use will somewhat be dependent on how many ETFs are being returned. And if we find that we're not getting many, if we're running our scan for ETFs and only 10 are coming back, then instead of 200,000, we might go to 100,000 or 50,000. Instead of a scooter score at 80, maybe we go to 70 or maybe we go to 60. We'll be altering that based on the results that we get. Now I want to move into limitations of ETF investing. Um, there's some obvious ones for me. And this is what I said at the open, where I said, I'm not a fan of ETF investing. I know many of you are, and I'm not trying to change your mind. If you want to be, in ETFs, I recognize many of you want ETFs. We've had a lot of emails over the years that we've been in business. Start up an ETF service for us, please. We don't like individual stocks. So I get it. And I understand that many of you don't want to trade individual stocks. You want to be in ETFs. That's why the service is starting. What I can tell you, though, is that when we put together a portfolio of individual stocks, every stock in our portfolio, we picked. We like them. They're all leaders. And so, if they go down, they're our fault. We picked them. With an ETF, you're getting a basket of stocks. Some of those stocks in that portfolio I might love. There might be stocks in that portfolio I don't love, though. And so I'm just I'm buying a basket of stocks, some of which I'm not going to be a big fan of. And so my personal approach is I'd rather have all of my money working in individual stocks where I like the stocks. So I will not be buying these ETFs. I can tell you that. And sometimes, our members write in and say, well, if you're not doing it, why should I be doing it? Well, I'm telling you why I'm not doing it. I'm not saying that's your approach. I'm just saying that's my approach. I want every stock that I own to be a leader, and I can't do that with an ETF. The thing is, if you want to go out and get some food and you don't like something on your sandwich, you just told them to hold it. You go to McDonald's and say, well, I really like the Big Mac, but I don't like onions. Well, you go in line, you say, give me a Big Mac and hold the onions. Well, if I go in and buy an ETF, I can't tell them to hold this over-the-counter stock that I don't want in there. You get them all. So you're getting all the onions too. It's not just about the burger. And I'm not saying I like McDonald's, but I'm just trying to give you an analogy there. Also, many stocks won't meet our stringent criteria in the ETF. There's going to be a lot of these stocks. They're not on our strong earnings chart list. They're not on our strong future earnings chart list. They're not on any of our chart lists. And yet they're in an ETF that is likely to be in our model ETF portfolio. So as far as I'm concerned, that's a limitation. And I'm going to be showing you some more charts, by the way. I know I'm just kind of talking right now, but I think it's important that we go through and you understand our methodology as well as the limitations of having an ETF portfolio. I talked earlier about the scooters. We're going to be putting these ETFs together based on scooters. Scooters have limitations. As I mentioned, they only go back 5 or 6 months. You could be in an ETF that has a 90 scooter score, but if you look at a 3-year chart, it's been underperforming primarily over the last 3 years, but we just had a pop in the last 3 or 4 months, and now it's showing up on our chart list. That may not be something I'm interested in. So scooters have limitations. By the way, think something like material stocks. They've been underperforming the S&P 500 for 9 years as the dollar's been strong. Recently, the dollar's taken a hit. As a result, material stocks have done better. So you might see materials ETFs coming up onto the list, but I might hesitate to include them because the long-term track record is not good. So that's a limitation. Our strategies, to be quite honest, may not align with your strategy. You might be a very conservative investor. We're looking at this trying to find areas that kind of appeal to us at EarningsBeats. So if you're looking for, a portfolio that's going to be evenly balanced and, has very little beta, that's not going to align with what we're going to be putting together. I can promise you, just again, because of our philosophy. And I'll mention again, we're not registered investment advisors. So we're not advising any of our members to do anything. We are providing research on these ETFs. We're providing you, just like you see on your screen right now, we are providing you information to hopefully enable you to make better decisions on which ETFs you want to own. Some of these ETFs, sticking with these limitations, some ETFs contain securities other than stocks. New York Stock Exchange listed stocks or NASDAQ listed. We could have over-the-counter stocks. I don't invest in over-the-counter stocks. I don't believe in investing in over-the-counter stocks. I don't remember which one of our portfolios or ETFs that I was looking at. It's on this chart list right now. I don't remember. Maybe I can spot it by going back. Just give me a second. Let me see if I can find which one it was. It's probably one of these ARK funds. Let me try this one. No, that's not it. But I do think it was one of these ARK funds. That is not it. Not that one. Might be this one. Darn it. There's one that I adjusted, and there were four of their top holdings were over-the-counter stocks, OTC stocks. And I'm just not seeing right now which one is which. Maybe it was in global robotics. Yep, here it is. All right, so here's the top 10 holdings. Look at 5 of the top 10 holdings accounting for almost 15% and probably another 13%, probably close to 30%. And this is just top 10 holdings, so there are others on this list as well. But 30% of this ETF is based on over-the-counter stocks. You might look at this chart and say, wow, this is a great performer. I'm going to jump in. Well, it helps to know that you're also investing in over-the-counter securities. I mean, NVIDIA is nice. Intuitive Research, that's nice. Or excuse me, Intuitive Surgical, that's nice. But these others, I don't really know anything about. RSW.L, that's a London-based company. You're getting foreign companies involved here. I'm just not going to be a fan. And these are stocks or ETFs, I should say, that I'm going to ignore. Some of these ETFs are going to have bonds in them or convertible bonds. Some might have different levels of cash. All of these things I think you need to be aware of. I mean, I wouldn't invest in a mutual fund. Years and years ago when I did invest in mutual funds, one of the reasons I got out of the mutual fund area was because I started realizing that mutual funds many times hold substantial amounts of cash. So I'm taking my cash, thinking I'm putting it to work in a mutual fund, and then come to find out 30% of my money was still in cash. These ETFs, while I haven't seen big amounts, they do sometimes hold cash in these. So you got to be aware of that. And then a final limitation that you need to be aware of is when you buy into an ETF, they have expenses. All of your money is not going to work and being invested. Now that we have zero commission trading, when you buy stocks, every penny of what you're putting in to your account is being invested. With an ETF, you might have 0.2%, 0.4%, 0.6% that's being charged. So not all of your money is invested. And that's something to think about. That can have an impact on your long-term return. So that's another limitation of ETFs. All right, so let's move on to evaluating ETFs. So if I pull up an ETF, and I'm just going to use the one that's on my screen right now, I'm not going to be interested because of the over-the-counter, but let's just assume all of these 10 stocks were New York Stock Exchange or NASDAQ stocks, whatever, US equities. I also want to evaluate the ETF based on the sector weighting. So as I put together these ETFs, one of the things I'm going to be looking at, and just to give you an idea, let me see, I'm going to go in and show you. I have a relative strength industry group chart list I talked about, but I also have relative strength sector chart, which is easy to put together. It's only 11 sectors, but it's essentially the same as the industry group chart list. It's just that it's only sectors. Now look at technology. This is relative strength, technology versus the S&P 500. Do you think you might want to own technology? I mean, the last 2 years, it's been going straight up. It's outperforming the S&P 500. If you own the XLK, which is an ETF that tracks technology stocks, you got a pretty good chance of outperforming the S&P 500. Why? Because this ETF is crushing the S&P 500. So when I look at these individual ETFs and I see technology is weighted very heavily, I'm going to be a fan of that ETF. Just looking at sector weighting. Again, I'm ignoring over the counter over here. So that's part of the evaluation process. The other thing is when you look at the top 10 holdings, if I added up all of these top 10 holdings, I'm going to find that these top 10, that this is a highly concentrated ETF. This is one where a limited number of stocks have a very, very strong impact on the performance of this ETF. So how these individual stocks look on their individual charts and how many of them are included in our chart lists, that's going to have a really big impact on whether I'm interested in this ETF as part of our model ETF portfolio. Hopefully you kind of understand where we're coming from on this. Now imagine one that is much more diversified. So let me see if I can find something that's maybe, how about the Russell 2000? Now this will give you an idea. Oops, let me annotate this and drag this over so we can see this. Okay, so now when you look at this, now, of course, you probably already are aware that the IWM is invested in the Russell 2000, which is, small companies, small cap companies. And you can see there's your top 10 holdings. You see the difference in terms of concentration? This is an incredibly diversified ETF. So one stock is not going to have much of an impact. The top 10 holdings is not going to have much of an impact. Am I going to sit here and evaluate 2,000 companies on our chart lists to determine if I want to own the IWM? No. If I like small caps, I would just buy I would just include the IWM. Not a whole lot of evaluation of individual stocks needs to take place. However, look at the sector weights. That's going to play a part. I mean, because if I decide that 30% of the model ETF portfolio is going to go into the IWM, 30% of this 20% means that 6% of our entire portfolio is in healthcare, simply as a result of owning 30% of our portfolio in, putting 30% in the IWM. So 30% of every one of these numbers, if we want to determine at the end of the day, if we've got 5 ETFs in our model ETF portfolio, one of the things we're going to do is we're going to calculate the sector weighting. Again, if we're 30% IWM, then it's 30% times all of these numbers to calculate how much of the sector weighting results from owning the IWM. If we do the spider for 50%, and I'm just throwing this out there, I'm trying to outperform the S&P, so I'm not going to include the S&P. But if I was going to do that, I would have to find out the sector weighting of the spider, and 50% of the numbers that show up would then be included. And so the idea is after we put together the 100% of the portfolio, I'm going to be able to add up and tell you what percentage is in each of the various sectors. So what I can tell you is that going back and looking at the sectors relative to the S&P 500, technology, I'm going to want to have a high percentage of. I love consumer discretionary. Look at consumer discretionary. It has been on fire since March. It's killing the S&P 500. So am I going to be looking for 10% to go into consumer discretionary? Heck no. I'm going to be looking for 30%, 40% maybe. that are going to be in consumer discretionary. I want to overweight consumer discretionary, not underweight it. I'm just telling you how we're going to be putting these together. Now, you may look at the list and you might say, hey, you know what? I'm going to put mine together a different way, and that's fine. You know, we have a lot of members that don't follow our portfolios. They may look at our chart list and, you know, decide what they want to buy on their own. That's fine. You know, I look at our portfolios really as kind of a, I don't know, maybe you know, if our service is the marriage of fundamentals and technicals, I kind of look at our portfolios as the child from that marriage. I mean, we're looking at stocks and we're changing them out every 90 days, but we don't have the trading characteristics like stops. When we get in to these 10 equal weighted companies in our stock portfolios, we're holding them for 90 days. That's kind of a buy and hold approach, but it's a trading approach in that we are going to change, and we're going to, you know, come up with a new list for each of our portfolios every 90 days. So it's a little trading, little buy and hold, but for members who want to be in leading stocks, but say are at work all day and don't have time to manage their trading every day, I think portfolios make a lot of sense. And, you know, that's kind of the feedback we get from our members. So I'm looking at this as kind of being similar. You know, the ETF portfolios or portfolio, we're just starting out with one. Maybe we have more down the road. I don't know. And when we started with just one on the stock side, we're up to 4 now. So this is something that definitely could evolve over time. But the process is going to be that we're going to hold these ETFs for 90 days. And that we're going to be looking at the various sector relative strength charts. And we want to be in the ones that are, you know, strong. Communication services, we've seen some pullback recently, but this is a long-term uptrend. And I really like the internet space, which is a big part of communication services. We're starting to see communication services rising, which I think is important. Industrials have been down for a while, but we're starting to strengthen. We're above the 20-week moving average, 20-week relative moving average. I'd like to see this bounce off that rising 20-week and break out again. If we do, industrials will probably start to get more weight down the road. Currently, yeah, maybe I'm going to want a little bit of exposure. You can see the weekly PPO, relative PPO, has turned positive. So we're starting to see some positive signs in the industrials. But this is kind of where I was coming from before. You can see that over the last 2-3 years, we've seen relative weakness in industrials. Can we trust this? I don't know. I like the fact that transports have broken out, so I can make an argument that we want to have some representation in the industrials. Financials, probably not as much. I will probably be limiting exposure to financials. And if the 10-year Treasury yield goes up, I expect financials will go up. Will they lead? I don't know that they'll lead, but I do expect that they'll do better than they've been doing. I still want relative strength. Remember, not just absolute strength, relative strength. So what about areas maybe, you know, healthcare has not been performing as well. So maybe healthcare is something that we don't want a huge interest in. Consumer staples, defensive group. You know, I believe we're in a secular bull market. I think consumer staples will underperform. Real estate. You know, now we've been in this thing for 13 months where we've seen a lot of underperformance in real estate. I'm not going to be looking for funds that have a big exposure in real estate. Utilities, also in a downtrend, not really that interested. So energy, outside of renewable energy, you're probably not going to see any energy in the ETF because, you know, and this isn't just 3 years, I mean, or 2 years, we can go back 10 years and look at energy relative to the S&P 500. I mean, trying to catch these periods when energy bounces on a relative basis, I mean, yeah, it'll be great if we happen to catch it, but right now it's free falling. I'm not interested in trying to catch this relative falling knife. So those are some of the things that, you know, we're going to be looking at in trying to, you know, evaluate. All right, let's move on to ETF examples. I did bring up one, and I want to show you a little bit more than just the FDN, I'm going to show you something that maybe you are not at all aware of. This might be a new thing for many of you. I'm trying to find that FDN again. Okay, so here's FDN. And here is Amazon. I'm going to just jot these down real quick. Amazon, Facebook, CRM, PayPal, and Netflix. I'll just do the first 5 here. And Amazon is 10.54%, Facebook 7.55%, CRM 5.80%, PayPal 5.26. I'm jotting this down. I'm not just trying to read this to you. 5.06 for Netflix. All right, now I'm going to bring up, hold on, bear with me again for a second as I swap screens. I'm going to move over now to Google Chrome where I have a different stock charts account set up. And in this stock charts account, this is the one that I had Grayson set up for me that we talked about back on Saturday in the webinar. And in this, I've now adjusted so that the only thing in this particular stock charts account are the 6 chart lists that I just talked about: strong earnings, strong future earnings, strong AD, weak AD, raised guidance, short squeeze, and also our 4 portfolios: model, aggressive, income, and strong AD. That's all that's in this account. Now I'm going to bring up, if you use this symbol summary, you can get pre-market and post-market, after-market price action. So I'm going to pull up Amazon. And you can see what a great day on Amazon today, up 4.3 or 4.75%. It's up after hours, another $8. Look at the chart. You can see a lot of good stuff. Well, I don't know if you know, but if you scroll down to the bottom, you can get the scooter rank. You can, some stuff that they're going to be working on, earnings, analyst ratings, some fundamental criteria that you'll be able to find here. Profile. You want to know what the company does. It's all here. And predefined scans, that Amazon is part of. You can see what, has been triggered. I don't have any alerts in this. Actually, I don't have alerts in any of my accounts because I'm staying in touch with the market so closely. But look down here at the bottom, chart lists with Amazon. Amazon's in our strong AD list. Amazon's in our raised guidance chart list. Amazon's in our model portfolio. I like Amazon. So when we consider that First Trust Dow Jones Internet Index Fund has 10.54% of Amazon, that's a bonus in my view. So this is how we're going to marry ETFs and our ETF service to what we already do using our research engine here at EarningsBeats. So we can quickly identify some of the top holdings, and I don't know how we're going to disclose this to everyone. I don't know if somehow we'll annotate. I'm kind of envisioning in my head maybe some sort of an Excel spreadsheet that can be downloaded. We have to find out what we can do from our website. These are some of the things that, like I said, are going to evolve over the next couple months. They're not ready just to lay out for you right now, but I think it's going to add tremendous value if you're an ETF investor to be able to see not only what's owned in these ETFs and not only to see the sector weighting and so forth, but to be able to quickly see in our research somewhere, I'm thinking Excel spreadsheet again, and maybe it's just a table that we post on our website somehow. I'm not sure how this is going to materialize, but we're going to try to do something where we provide you a tremendous amount of research that incorporates our individual stock analysis so that you can make better decisions about your ETFs. And that is the most important and most exciting thing. But I didn't know until recently, Grayson pointed this out to me, because I just hadn't scrolled down and really paid much attention to this symbol summary. And maybe some of you don't even realize that there's pre-market and after hours action. I mean, I can pull up QQQ real quick. Whoops. QQQ and see what's going on. After hours, it's up another 0.2%. It was up 3% today. You can see we're having this huge move. And I can also see after hours QQQ 0.19. How does that relate to Spider? Spider, it's a little bit better than the Spider. And today's action, QQQ is much better than the Spider. So there's a lot of different uses for it, but that's, a part of what we're going to be doing. All right, that is essentially what I wanted to go over in this webinar. I do want to mention the last piece of this webinar, which is our draft. The draft of the Model ETF Portfolio Component ETFs. That's going to take place next Monday at this time, 4:30 p.m. Eastern. It is a member-only event. This is free to the public. Anybody is out there can come in. We want to, let you know what we're doing to see if this is something that is appealing to you. We try to price this and all of our services so that everyone can afford it. I mean, honestly, we have professionals who use our service, and we could probably put together the best professional service out there. We have professionals emailing us, telling us we already have the best service, that they've given up on other services and they're sticking just with EarningsBeats and stock charts in evaluating their portfolios and helping their clients, which I'm very grateful for. But I want to help everybody. I don't want to just help those that are professionals in this business. I believe that there's a lot that we can do to help each individual in managing their trading account, their 401ks, their retirement, if maybe it's a Roth IRA, whatever. And that's why we do what we do. And that's why we try to price it as best we can. I think we're worth every penny that we offer. And when you go through and you look and you see the research and the quality of our research and adding on this ETF service, I think hopefully you will agree that this is a really value-packed service that we offer. So last thing I want to do before we go is I just want to again mention to everyone that we have this webinar special. It extends through Friday, so you have 5 days. If you're new to our service, never tried us before, try the trial. If you go to our homepage right here, join today, click on that. Here's what you get: a $0 charge for 30 days. All right. Now, you're going to get hit with a $7 initial charge. We're going to refund it to you. So there's a net $0 cost. It's really about getting you set up in our system. We have to charge something. But after that, you've got next 4 days to decide if this is, and we have specials all the time. This is if you're an ETF investor, this is kind of a special you might want to pay attention to, though, because you will not have to pay for anything relating to the ETF service until the end of this annual period, which if you have a trial 30 days and then you tack on the 13 months that we're offering under this special, that's going to take you out 14 months from now. It'll basically take you through the end of next year with just paying our normal fee, no upcharge for ETF. And then once you get beyond the ETF or beyond that period, there will be an upcharge, but we'll have a bundled price. So if you like both of, if you want individual services, it's going to be X. Like our current service without the ETFs is $697. We'll probably do something with the ETF, which maybe is going to be, I don't know, maybe $497. And then there might be a bundled package that if you want both, would be $997. But right now, $697 gets you all of that, and you don't have to worry about coming out of pocket for anything else until you expire. And for those of you that are already annual members that go out to next year, you're included. So I'm sure there might be a lot of questions coming in. Do I have to, pay another $697? No. Anybody that's an annual member right now, if you're paid out for another 12 months or 18 months or whatever the heck it is, you're going to continue to receive whatever it is that we offer at this regular price. There's going to be no added amount to pay. So I think it's a great deal. Again, we want to give back to those of you that have committed to us. We're very thankful for all of the support we received since I returned back to EarningsBeats just over a year ago. You know, our service continues to evolve. We're adding a lot of great features. We're adding a lot of folks to help us here as well. I can tell you, you know, that Abby, who's been with us for a while now, doing an outstanding job. I think any of you that have dealt with her on the customer service side know it. But Abby also has a lot of background in terms of social media marketing and so forth. She does a lot of that for us. We recently hired Matt Townsend, who is a finance graduate. He's working with me on this new service, the ETF service. So he's behind the scenes trying to help out. My daughter, Erin, who's on maternity leave, she's got a background in public accounting just as I do. And she focuses on analysis. When she comes back, we'll have plenty to keep her busy. And then, of course, me, John, and John's son, Chris, really round out the team here at EarningsBeats. And I can promise you, everybody works hard. I'm really proud of every part of our service, including customer service. We try to get back to you as soon as possible. If, you know, sometimes you'll get a response from me on a Sunday morning. John, you might get a response at midnight on Friday or something if he's, you know, checks in. Abby and Aaron also getting back to everyone very promptly. I'd like to think our entire package at EarningsBeats is top rate. So anyway, that's all I had, John. I don't know if you have anything to add, but I certainly hope many of you take us up on this all.
No, that was great. Now, the reason they might hear from me at midnight is I go to bed at 9. I'm probably waking up at midnight, so I'm ready to go.
Yeah, I know. That's about the time you get ready for the next trading day, isn't it? Right around midnight?
Exactly. No, hey, this is fantastic, really. And everybody's going to get a copy of the recording. Can't wait till next Monday. We'll have the draft. Give everybody plenty of notice. Take us up on this special. Like Tom said, it's not going to get any better. And I think you're going to be, you know, very, very satisfied. So great job, Tom.
Yep.
We're going to be on me.
Yeah, I look forward to it. Like I said, you know, I'm a stock guy, but I know that there are a lot of folks that like ETFs, and I hope you found something interesting in this presentation tonight. All right, that is it. Again, thanks for stopping by, everybody. Appreciate all the support you've given us, and hopefully you'll take us up on this offer. Everybody have a great evening, and we will be back tomorrow. Happy trading, everyone.